Before I begin to this video, let me give a quick disclaimer. I am not a financial advisor. The content of my videos represents my personal opinions and is provided for informational and entertainment purposes only. My information is not intended to be legal, financial, or an investment advice. Always conduct your own research and due diligence before making any financial decisions. Remember, it's your money. Please make informed decisions that are right for you. I'll never ask you for money, nor will I provide my phone number or personal email address. If you encounter any suspicious accounts or messages claiming to be me, please report them immediately as fake or scam accounts. Hey investors and traders, welcome back to Talk Stocks with me, your weekly market compass. This week was nothing short of dramatic in the world of macro and the markets. On Wednesday, US mortgage applications surged 20%, hinting at a housing market rebound many didn't see coming. Meanwhile, in a major geopolitical twist, President Trump hit China with a 125% tariff hike while pausing other tariffs for 90 days. The market loved it. The S&P 500 jumped 9.5% in a single day. Across the globe, China's inflation dipped 0.7%, stirring up fresh deflation fears. Back home, US inflation cooled. CPI came in at 2.4%, down from last month's 2.8%, giving the Fed some breathing room, but don't get too comfy. The ECB dropped hawkish hints, which is the European Central Bank, and the Fed's minutes showed a more cautious stance. They really walk in the tightrope. To cap it off, consumer sentiment in the US tanked, falling to its lowest level since the pandemic. People are clearly worried about inflation and those tariffs. Now, what does this mean for your portfolio? Stick around and let's break it all down. All right, let's settle one of the biggest questions every trader or investor asks. What time frame should you be using? Well, the answer depends on you, your goals, your schedule, and even your personality. Very funny. Here's a quick breakdown. If you are an investor, think long-term wealth building. You want to zoom out. Use weekly or monthly charts to spot the big trends and avoid the noise. This is for people who don't want to check charts every day. Think retirement portfolio, ETFs, or dividend stocks. If you're a swing trader holding positions for a few days to a few weeks, you'll want to use the daily chart and maybe the 4-hour chart. This helps you catch short-term moves without needing to stare at your screen all day. Now, if you're a day trader, going in and out of trades the same day, you'll live on the 15-minute, 5 minutes, or even 1 minute chart. This is fast-paced, high pressure, and needs laser focus. Definitely not for the faint heart. My tip is, start with a higher time frame to get the bigger picture. Then zoom in for your entry and exit decisions. And remember, don't use a 5 minute chart to make a 5-year decision. So what's your style? Let me know in the comments below. Let's begin this week's demo session by looking at the performance of the S&P 500 financial instrument from the data gathered from 1928 to 2024. What I have here is the year open, the year high, the year low, and the year close. Based on this data, I can estimate the annual return. Now, what you can see here is when you have a green, when I paint this font green, it shows you had a positive return that year. When the font is red, it shows you that you have a negative return that year. Now, let's just inspect this data. You can see that you have some years where you have a negative return. You also have some months where you have a positive return. Now, to better understand this data, I created a flag or an indicator. This indicator gives a value of 1 when you have a positive return. So even if you have 0.1 that year, it's going to be a 1. If it's below 0, it's going to be a 0. So it's below 0%, you're going to have a 0 for the up or down value. Now, why did I create this field? First of all, the reason why I created this field is to be able to do probability. So if I come right to my table here, I want to show you that probability is telling you that if you buy this asset, the probability that you will make money that year is 67%. Let's remember when we were in school, when you flip a coin, when you can either be a head or a tail. Now, if someone tells you to pick whether head or tail, you can say head or tail. Well, in terms of probability, it's 50-50 because it's a fair coin. So it can be, yes, it's a game of chance. But now we are seeing with data collected from 1928 to 2024, the probability that you will make money, if you have no idea, you just pack your money in this, is 67%. Trust me, that is a very good probability in your favor. Now, let's look at this figure here. This figure here is me portraying the annual return in terms of a visual. And I chose this visual because this visual can show you the relative distributions where you had the annual return above 0 and below 0. Clearly, you can see that you have more bars above the zero line than below the zero line. This is also in favor of this statistic that is telling you that once you buy this asset or you invest in this asset and you sit down there for a year, your probability of success is 67%. Now just imagine you create a strategy to optimize this 67%, meaning rather than sitting down for the whole year, you come up with a way to be in this asset in those years where you have a positive return, meaning you want to save yourself from the remaining 33% where you have a negative return. Is it possible? I'll tell you yes. Many people believe buy and hold. I have no problem against buy and hold, but why must I hold in this 33%? Does it make me right? Does it make you wrong? You can choose to do what works for you. Now let's look at the statistics. I'm a statistics guy. Now the annual returns for S&P 500 from 1928 to 2024 is telling you that the average return is 8.01%. Meaning if you pack 10,000 into this every year, the average annual return that you should expect, which is the mean, the expected return is 8.01. Now the mean is sensitive to outliers, right? Some year you might have very beautiful performance, somewhere you might have a terrible performance. So now if we decide to use the median, because the median is less sensitive to outliers, the median return if you invest in the S&P 500 every year is 11.39%. In the West, where we have inflation ranging between 4 to 5%, ideally you can see that you are definitely beating inflation and growing your wealth. The maximum, so this was the maximum return that the S&P ever generated, was 47% if we round it up, and the minimum return is minus 47%, something like give and take. Now that we have a high level understanding of this asset, I'll also like to show you a different chart to gain your understanding on the chart. I went to Google Finance and I put the VTI, which is the Vanguard Total Stock Market ETF, as well as the Vanguard S&P 500 ETF. And you can see first of all that they match each other very closely. The S&P 500 are the 500 top stocks in the US. The Vanguard Total Stock Market includes the S&P 500 and other stocks that make up the market. You can see they have a very close agreements with each other. Now, I went to the 5-year chart to see that we're in 2025. So in 2020, if I had invested my money, how would I have grown my wealth? You can see that without doing nothing, by just parking my funds in VTI as a buy and hold investor, I will have made 83% on my capital, which is a very remarkable return on investment. So if I divide this by 5, this is roughly, this is 1, this is 3, so there's almost 16% per annum, which is very remarkable. Similarly, the S&P 500 is giving something close to that. Now let's expand it to max, and you can see how people have grown their wealth. So the maximum return is 352 for the total stock market and 381 for the S&P 500. Now let me show you how I play this ETF as a technical savvy trader for my long-term portfolio. I have on screen VOO on the monthly chart. Now clearly straight away you can see I'm using the monthly chart for my investment decisions. Why does the monthly chart help me to make that decision? Remember, when you are operating on the monthly chart, every candle is formed with an entire month price action history, meaning how traders, investors, this candle encompasses their sentiment. If I go to the daily chart, it means I want to be making my decisions every day. And trust me, investors and traders are emotional. And it means you are going to have to make a decision based on so much volatility, noise, and emotional bias. Working on the monthly and the weekly chart ensures that I'm not making my decisions daily. And remember, when in statistics, whenever we have to make decisions, either by creating a model, we create a matrix, which is called a classification matrix. And what entirely we are trying to do is to assess the accuracy of the model. And what we do is look at the true positives, the true negatives, the false positives, the false negatives, from which we create metrics such as recall, accuracy, and so forth. Now the idea is when you make decisions, because each of these candle is data for you to make a decision as an investor. For instance, if I look at this candle here, this is something called a bearish engulfing candle. Now typically this is a change of sentiment from bullishness to bearishness. Ideally you are supposed to make a decision to sell because of this candle. Now the idea is, if you use a daily chart, you are going to see many more occurrence of this bearish engulfing candle. And ideally, are you going to keep selling every time you see that candle? Now there are two things that can happen. There's something you call false positive, meaning the decision based on the candle is for you to sell, but it was a false signal, and then you will have made your decision to sell. and you see the market going up. Now, it's not a crime if you join back to the market, but that's part of the pros and cons of making decisions daily. However, if you think big term and you zoom out to make your decision once every month, you will only have 12 months in a year. So for your long-term portfolio, which is geared towards retirement or even not retirement, well, I'll say for a broader horizon, you can ideally wait for the end of every month to make your decision. Now, this is my strategy here from this asset from 2011 to 2025. When you see a long portrayed on the chart, this is when I buy, and when you see an exit long is when I exit the market. And you can clearly see that the current signal is exit, but prior to this exit, this was where the long signal happened. So based on this signal, this is how much returns if we just mark it from here. So it means roughly this is 62 roughly, but we would see the actual percent in the back end of the strategy. Now, one thing I want you to know is that let's look at it. So now if we open the back end of the strategy, these are the list of trades that you'll have made with the strategy. You can see there are only 7 trades, so it's labeled from descending order. Now there are only 7 trades. Now let's do some math. From 2011 to 2025 is 14 years. 14 years is 14 times 365. That is roughly 5,100 days. And you only have 7 trades. So it means the probability of making a trade with this strategy is 7 divided by 5,110, which is less than 1%. Just look at that and just think about that. You only have to make a decision. Every day you wake up, your probability of making a decision is 1%. However, if you are working on the daily chart, it means you have a 50% probability of making a decision because it's either yes or no. In fact, you have, because yet you still have to even make a decision every day. I only have to make a decision 12 times in a year. So let's recheck that. You have to decide either to buy or sell every day, so it's 50%, it's either yes or no. But I only have 7 times in history where I had to make a decision, which is less than 1%. Now let's go to the beautiful thing about the strategy. You only have to have made 7 trades. This strategy has a win rate of 71%. Just look at that. 71%. From 5 trades, from these 7 trades, 5 were successful, 2 were unsuccessful, and the profit factor is 8.851. Let's get some definitions. Profitable trades means the percentage of winning trades. That means the number of winning trades divided by the total number of closed trades. Now, what is the profit factor? The profit factor is the amount of money that this strategy made for every unit of money it lost. Gross profits divided by gross loss. Now, let's look at the list of trades and let's just quickly walk through them. Your first trade is in 2011. You see, to September, you lost 12%. The next trade, so you were away from the market between September to February. What will you be doing at that time? Well, I can tell you free of charge, you can invest your money in the US Treasury ETF, which is risk-free, and you'll be getting your annual return. So your money is still working for you. You get back to the market in February 2012, and you stay in the market till 2020 to 2015, and you get an average return of 54%. You've made back the money you lost here. The next trade too, you lost 11%. You're still net positive. We had 11 plus this is 23. You're still positive 20% in your portfolio. And look at the subsequent trades: 33%, 2% here, 40% here, and 35%. So the trade that was just closed between December 2022, which is this, to April 1, 2025 is 35%. Well, this is because you chose to get out with this strategy. And let's just stick to that strategy. But as a technical investor, you could see some candles being printed, which were telling you, hey, shit is about to hit the fan. I don't want us to make strategies, but for instance, this is a doji candle and this is a bearish engulfing candle. Remember when we got a bearish engulfing candle here and also here? That is a harbinger for bearishness. Now, I think the last thing I also want to highlight in this strategy is the trades analysis. So if we roughly look at this, if we quickly look at this, this is telling us here that the total trades is 7, winning trades 5, losing trades 2%, profitable is 71%. The average winning trade, so for the 5 trades that you made money, the average return is 33%. For the 2 losing trades, the average return for the losing trade is 11%. This is the ratio of average win to average loss. Every definition is here in TradingView. So if you click on it, it will come out there. The most profitable trade was at 54%. That's the largest. And the worst trade, which is the largest losing trade, was just 12%. This is how to invest mechanically. I know many people like to say things like, oh, I love investing in red days. Oh, I love to see red. I only invest when it's red. I love to DC. I mean, those are strategies that are based off emotion. And I'm not saying they don't work. They do work. But I'm just showing you an alternative approach where you are just following a strategy. No emotions. You don't need to read news. You don't need to listen to what your neighbor or what your baba is saying. You just focus on the charts. I want to show you something interesting on the daily time frame before we wrap this video. So if we go to the daily time frame, pardon that my signals will still show on the daily chart, but let's just pretend as if they okay. What I'm going to do is that I'll take my strategy off so that we can go to the daily chart. This is the S&P 500 on the daily chart. Guys, remember, my strategy had told me to exit the market. And so, let's assume, where's the 1st of April? So we exited the market on the 1st of April, which is somewhere here. Good, somewhere here. So let's just mark it, which is somewhere here. Perfect. So this is the 1st of April. Now, so it means since I exited, I really don't care about what is happening. All this is noise. All this is noise to me. I am going to sit down and wait till the end of the next month. So all this noise is, look at it in terms of a candle. It's just this candle here. Look at it here. It's just this candle. This is April. This is the candle. Look at this volatility. Ideally, you're supposed to make decisions with this every day. Decisions in terms of the candle, in terms of the key levels. Those are the number of decisions you have to make. Here you come, you say it's a very bullish candle. Look at the length, and perhaps the volume too might also, support that. You can see the volume. But I don't, as a monthly trader or a monthly investor, I really don't care about what is happening on the daily level. My job is to wait till the end of the month to assess my trade. Even let's look at the weekly chart. You can also look at it on the weekly chart to make your decision. You see, it's even clearer on the weekly chart. This is almost like an harami or something like that, but let's see how it's going to portray. But look at the difference when you look at the larger time frame. This is the weekly chart. This is the candle, rather than this where there's so much noise and volatility. Well, it's good for day traders, but that's why, if you remember my video, who are you? Are you a day trader? Are you a swing trader? This will help you when you are making your decisions. So remember, guys, I showed you the numbers. Some of you might say these numbers are not flashy, but that's the point. It's a steady compounding strategy designed for consistency over time. What is my key takeaway? You don't need to trade every day to win. You just need a repeatable edge. The real challenge, however, is staying calm. Markets will test you. Emotions will make you panic. Strategy keeps you in the game. When you trust your system, you stop reacting to headlines and start responding with logic. What's my final thought? Don't try to outfill the market. Try to outthink it with a tested long-term edge like the one I showed you earlier. Now, guys, let's commence our weekly commentary of the market and give the outlooks solely based on technical analysis. The US large cap market, tracked by the ETF VTWO, recorded a week-to-date change of positive 9.12%. Year-to-date, VTWO has delivered negative 8.96%. The short-term bias on the daily time frame exhibits a bearish trend, while the mid-term outlook on the weekly chart is neutral. Moving on to the Nasdaq, tracked by the ETF QQQ. This week saw a change of 11.19%, bringing its year-to-date performance to negative 11.12%. The daily time frame exhibits a bearish trend in the short term, while the outlook on the weekly chart is neutral. US small cap stocks, measured by the performance of VTWO, this week posted a move of positive 5.77%. Year-to-date, VTO has returned negative 16.63%. In the short term, the daily time frame shows a bearish trend, and the midterm outlook on the weekly chart is also bearish. Canadian equities, tracked by the ETF VCN, printed a weekly change of positive 5.55%. Year to date, VCN has delivered a return of negative 4.36%. The short-term trend on the daily time frame is bearish, while the midterm outlook on the weekly chart is neutral. The Nigerian market, tracked by the index ASI, this week saw a change of negative 0.90%. Year to date, ASI has delivered a return of positive 1.59%. The short-term outlook on the daily chart is neutral, while the mid-term trend on the weekly chart is bullish, although it's slightly waning. Oil commodity, tracked by the ETF USO, recorded a performance of positive 1.25% this week. Year to date, oil prices has delivered a return of negative 12.03%. The short-term trend on the daily chart points to a bearish trend, while the midterm outlook on the weekly chart is neutral. Finally, Bitcoin, tracked by GBTC, posted a change of positive 9.21 this week. Year to date, Bitcoin prices has delivered a return of negative 10.47%. The short-term outlook on the daily time frame is neutral, and the midterm outlook on the weekly chart is also neutral. As we wrap up this week's outlook, the message across global markets is clear. Short-term uncertainty is dominating, with bearish sentiment showing up in the US market, oil, and even the Canadian market. But remember, midterm trends are still holding steady, neutral for most and bullish in places like Nigeria. This isn't the time to chase hype or panic over headlines. It's time to zoom out, stick to your strategy, and let your edge do the heavy lifting. Whether you're investing or trading, patience, discipline, and perspective are your real superpower. Stay focused, stay informed, and I'll see you next week right here on Talk Stocks with me.